Good evening, everyone. Welcome to Your Money, Your Call. I'm Nina May. Roger, Josh, welcome to the program. Roger, thanks for coming back again on Your Money, Your Call. Josh, it's your first time, so welcome to the program. Terrific to have you on the show. What are your thoughts on how it all looked today, and I guess what investors who are sitting in the hot seat, what should they be doing?
Unlike Josh, I don't know much about support and resistance and those sorts of things. I focus purely on what businesses are worth, and if I aggregate all the valuations that I've been doing over the last month and a half, after the results, for the full year, I get a valuation for the index of about 3,900. Now, the stock market has 3,000 funds chasing roughly 500 companies that make up about 90% of the market capitalisation of the Australian market. So generally the stock market tends to trade at a premium to my valuation. It's at a really big premium at the moment, and I can't find many things to buy, and that's certainly been the case now for a couple of weeks. So I haven't found many things to buy, but let me say this. If investors are net purchasers over the next 2, 3, 5, 10 years, if they're net buyers of stocks, you actually want the stock market to go down, not up. So they shouldn't fear this. This should be seen as an opportunity.
Okay, well, I'm sure we'll know soon enough how things are going to head, at least in the short term. Gentlemen, plenty of callers already waiting to have a chat with you, so we're going to go to one of our regulars to begin with. We've got Abe from Sydney on the line. Lovely to chat with you, Abe. Good evening.
Yeah, good evening. Thanks for taking my call. My question is about the BlueScope BSL. Would you think that it's a good buy at this level? And if you are already invested in the resources, would you go into it further at these levels, or would you wait for more of a downturn?
Roger.
BlueScope conducted a capital raising some time ago, and that capital raising was very, very dilutionary, both in terms of the equity per share and also in terms of the return on equity. It became a significantly lower valued business, or a business with a lot lower worth. It's not at sort of circa $3, it's not trading anywhere near that valuation. It's way over. There are better businesses in terms of economic performance, as well as businesses that are closer to their intrinsic value.
We've got Simon from Brighton up next. Hi, Simon. Hello, Simon, are you there?
Yeah, good evening. I'm calling in relation to a terrific little company called Laguna Resources, or LRC. Just wanted to get your views on that. It's got a flagship project in Chile called Arqueros Gold, or the Gold Project. From what I understand, they've got 2 million ounces of gold as an estimate, with the cost of production standing at about $400 US. And transportation being only 3 k's away, so little to spend in terms of capex and any potential railway or that type of thing. Just wanted to get your views on this stock, and considering that it's got a tiny little market cap at the moment, where do you see it heading over the coming months?
Laguna Resources, new one for me, I have to say. I don't remember getting any calls on the show on that one before. Either of you familiar with Laguna?
Well, there's some interesting. Simon's given us some interesting information. We know the gold price. We also know the cost of extraction, or the cost of production. Simon's given us that. I'm assuming Simon's done his numbers correctly there. If you then calculate what you basically take the competitor's margin that they're making and estimate what a profit figure might be based on an annual production number, you can actually derive the return on equity for that particular company. And if you can do that, then let's say the return on equity is 50%. If you're happy in these sorts of speculative mining companies, you really want a 20% pre-tax return, then what you can say, or even 25%, then what you can say is, okay, it's generating a 50% return on equity. I'm prepared to pay double the equity to get half that return. So if it's generating 50% and I want a 25% given the risks, then I can pay double the equity per share. So simply take the equity, divide it by the number of shares on issue, look at the return on equity and pay a multiple based on that.
Aware of. We've got Kerry from the Gold Coast up next. Hi, Kerry.
Hello, Nina. Panel.
Hello.
G'day.
Nina, you're looking younger than ever.
Oh, good.
That's Roger.
She's married, mate.
No, I'll take that. Thanks, Kerry. You can ring any time.
Roger.
How can we help you?
Yes, Roger. I love your valuation assessments.
Thank you.
Now, I'm a bit of a big bear. how does it work?
Is that something your wife calls you?
No, I wish Nina would. Look, I'm a big bear. If the market really tanks, how does your valuation come into companies? I do understand what you're on about, but I'm talking about a 30-40% fall in the market. So how do you work out what to buy?
Okay. Well, the idea, this happened in March this year, and in fact, what we ended up with was a situation where there's a whole swag of companies that were good quality and absolute bargains. And look, if we're right, if the market does correct significantly, then that will be presented to us again. So the question is, how do you decide what to buy? Well, if everything's cheaper than our valuations, I would buy the best quality businesses, and I'd load up on the best things that I can get. I think it was Mae West who said, too much of a good thing is wonderful. And really what you want is to buy as much of the great businesses as you can. The valuations aren't based on price at all. The valuations are based on the economics of the business. So my valuation, for example, for JB Hi-Fi at the moment is around $19 or $20. That's what it's worth, based purely on the economics of the business. Now, next year, the valuation goes to $24 or $25, and the year after, it goes to $30. The first point is, not every business has that sort of growth in its value. A lot of businesses, their values are declining. Telstra, for example, its value just does nothing for the next couple of years. So the first thing is you want to buy businesses whose values are going up, and then what you want to do is hope that the price drops way below the actual value today. So if the price of the company drops, let's say, 10% below the value, you might buy a little bit of stock. If it goes 15 or 20% below, you'd buy a little bit more. And if it goes more than 25%, well, you basically buy as much of it as you can get and you hang on. Remember, only if you know the valuation of a company can you be confident doing that. Otherwise, you're just hoping that it turns around and goes up. And that's very different to valuing companies.
Okay, well, there you go, Kerry. Something to think about from the Big Bear. Appreciate your call, thanks.
She did it. She called you a big bear.
I did indeed. There you go. Moving on now to Mike from Sydney. Good evening there, Mike. Thanks for waiting.
Yes, good evening. That's okay. Enjoy your show, like everyone says. It's great.
Oh, thank you, Mike.
I'd like to ask Roger, if I may, about Rock Oil. I bought it, well, I'll explain. I bought it with the capital raising, extended my investment in them, and also one of the first stocks I bought when I first went in the market 18 months ago was Fortescue.
Okay.
And I've hung on to both of them.
All right. Let's talk about Fortescue first. Okay. Fortescue is a business whose price is based on projections about what it will earn in the future. It's not based on what it's earning today, and because of that, it's very, very hard to value. But can I propose with Rock Oil and Fortescue, if that particular caller sends me an email, and we did this last time, there's a whole bunch of companies that I don't cover, but I can value. So if they send me an email to, do you mind if I give the email address?
Of course,
to roger@rogermontgomery.com, I'll get a value for Fortescue based on what the projections are, and I'll get some optimistic projections and some pessimistic projections, and then you'll get a range of valuations. So that's about the best answer I can give at the moment. I tend not to value companies that aren't making money that justifies the price. I was just going to say, it poses an interesting issue though, doesn't it? Because you could have a view on the oil and you could be right on that, but then when you buy stocks, because you have a bullish view of oil, there's a whole bunch of other risks that you bring into the equation. You've got execution risk, you've got production risk, you've got board risk, and then you've got stock market risk. And
so does that also not happen when you buy on the gold companies?
Exactly,
on the basis
on
of gold commodities?
Any commodity stock. If I've done this before where I've had a view on oil, but I've bought the physical oil rather than a stock, and that way none of those risks come into the equation. So sometimes you can get the story very, very right with the commodity, and you sit there frustrated because the oil price goes, a lot of people have a view that oil's going to $200 a barrel in the next bull market, next bull run, but you might find you own a stock that goes nowhere. So my view would be, or my recommendation would be, to go and investigate the possibility of exposure to the commodity without a stock.
All right, we're going to take a short break. Back in just a minute. Stay with us.